President Biden just gave a press statement earlier today, and he says that our banking system is safe. And the reason why he says that our banking system is safe, even though we've just seen a few major banks in the United States fail, is because the government, along with the Federal Reserve Bank, created two new programs to help protect people who save their money in the bank and to help protect banks themselves. So starting with how they're protecting people who save their money in the bank, right now you have FDIC insurance, which protects you up to the first $250,000 that you deposit in a bank. That's been there for a while. Now, what has happened ever since yesterday, Sunday, the government with the Federal Reserve Bank said that now that they will protect you up to unlimited amounts of money. So if you have, say, $10 million in the bank and your bank goes under, you're not just protected for the first $250,000, you will get all of that $10 million back, even if your bank fails. Where are they going to get this additional $9 or $10 million that they have to pay you? Well, according to the government, this is going to come from a special assessment, aka a fee that's put on to the other banks. So they're saying that it's not going to come from tax dollars. The second thing you want to keep in mind is the new program that they created, a new lending program by the Federal Reserve Bank. This was enacted just yesterday on Sunday, called the Bank Term Funding Program. And what this is it's a loan that the Federal Reserve Bank is now giving to banks that are potentially struggling. That way banks can stay afloat, at least in the short term. That way you see less bank closures. So it's a two-pronged approach. Number one is if you insure people's deposits, because now no matter how much money you have in a bank, you're gonna get your money back if the bank fails. People should be less likely to pull their money out of the bank. That's the first prong approach, because their banking system is not designed for people to pull all their money out. But now if people are less incentivized to pull their money out, then less people will probably pull their money out. So that's the first prong. The second prong is now actually protecting the bank in case that they're running into financial issues and people are pulling their money out. The bank created this BTFP program, which will provide an additional source of liquidity. I'm reading this from the Federal Reserve Bank statement. It will provide an additional source of liquidity, aka money, against high quality securities, eliminating an institution's need to quickly sell those securities in time of stress, aka it will provide some short-term cash to banks if they need it, if they run into a credit crisis. Now, if you look at the markets, you'll still see that there are a lot of banks that are struggling. People are concerned about what this is going to mean for the banking sector. And the big thing now is, what is this going to mean for the Federal Reserve Bank? Because next week, the Federal Reserve Bank is going to announce their next interest rate hike. And prior to, let's say, 4 days ago, a lot of people thought, the consensus was that the Federal Reserve Bank was going to raise interest rates by another 0.5%, that they were going to get more aggressive with interest rate hikes, because just recently, Jerome Powell, who's the chairman of the Federal Reserve Bank, met with Congress, and he said essentially that inflation is not coming down fast enough. We need to get more aggressive with interest rate hikes, that we might have to raise interest rates faster and longer. Well, now, after all of this shakeup in the banking sector, everyone in the financial world is now saying that the Federal Reserve Bank is going to take a pause on interest rate hikes, or maybe do just a 0.25% interest rate hike. So it's interesting to see how quickly people have changed their perspective on what they're going to do with interest rates based off of what's happening in the banking sector. But now, why is that? Well, because many banks are struggling because of the high interest rates. And one thing that I want to especially point out, because a lot of people have commented to me on this regarding SVB, particularly Silicon Valley Bank. So Silicon Valley Bank went under because they had a lot of underwater assets. And one of those big assets were treasury bonds. And I talk about how they also were really involved with startups and tech companies who were underwater. But the interesting thing about treasury bonds is treasury bonds are supposed to be the safest investment around, right? If you put your money into the government, if you lend money to the government, that's what a treasury bond is. It's a safe investment. Well, they bought these treasury bonds when interest rates were very low. And so that means they paid a premium for them, because interest rates and bond prices are inverted. So when you have low interest rates, bond prices are generally higher. When bond prices are lower, interest rates tend to be higher. So they bought a lot of these treasury bonds when interest rates were low. And then interest rates went up, pushing bond prices lower, and now they're underwater on a lot of these treasury bonds. So it's kind of interesting that now people are saying that a big reason why the bank failed or had a lot of underwater assets was because they were investing their money into treasury bonds, which is essentially loaning money to the government, which is supposed to be a risk-free investment. Now, we did a full deep dive analysis on this, and my team is doing a deep dive analysis of what's happening in the banking sector every day in market briefs, in addition to covering everything else that's going on, which is why if you haven't joined market briefs yet, I highly recommend you do so. It's a super easy to read update on what's happening in the financial world. That way you can stay up to date when it's happening. It's completely free. I'll put the link to how you can join market briefs down in the description below. But this is where now understanding what is the Federal Reserve Bank going to do? Because tomorrow morning, we are going to get a new inflation report. And if inflation comes in hotter than expected, and then the Fed decides not to stay aggressive on interest rates, well, that would be a big pivot on the Federal Reserve Bank side, and that could maybe not cause more pain in the economy in the short term, but that means that the inflation problem is going to stay around longer than what people would like. And inflation disproportionately hurts the financially uneducated, it disproportionately hurts the poor, and it disproportionately hurts the middle class. Actually, inflation is a big reason why the middle class is eroding, which is why the inflation problem is such a big deal. Now, another thing that's interesting that happened or is happening right now is as banks started failing, first we started to see crypto getting hit because we saw some like crypto or crypto-like exchanges get hit very hard. Then after that, we saw Bitcoin prices start to rally while bank prices are going down. And so you're seeing some people in the crypto space saying, hey, look, this is a great opportunity to move away from the dollar, move into something like Bitcoin or crypto. Now, what I want you to understand is that crypto is extremely speculative. It's very volatile. Yes, I own Bitcoin, but I want you to understand the risks associated with crypto and Bitcoin and that it is very volatile. So understand that going in, but also gold has been rallying as well. I'm also an investor and owner of gold. I don't consider gold that I own an investment. I look at it as an alternative way to save hard money, but it's something that you're kind of seeing happen. Now, I don't want you to chase trends because look, the reality is we will get through this. You're going to see some great banks get hit very hard in the stock market, and which will create opportunities for some investors to buy some of these banks on fire sale because everybody is scared of banks right now. So that does create opportunity for some people there as well. But I don't want you to chase. I want you to stay calm and understand what's going on because this banking issue will settle. You're seeing the government get very involved. You're seeing the government come in and they bailed out the depositors. The Federal Reserve Bank is working to protect the banks. So you're seeing a lot of involvement on the government and Federal Reserve Bank side to protect banks and to protect depositors. So this will settle. Yes, you will probably see more banks get hurt, but it will create a great buying opportunity for some good banks for the long term, assuming you're investing for the long term, not the next 2 weeks or 6 months. But also understand now that there is bigger issues here. The bigger issues are, well, inflation, what is going to happen with interest rates, and what's going to happen with the economy. And while everybody keeps saying that inflation is already on its way down, inflation is still way higher than expected. Inflation has not gone to our target of 2%. It's still closer to the peak than the target that the Federal Reserve Bank is aiming to hit. Interest rates are going to have to go higher. And if the Federal Reserve Bank starts to pivot right now, you might see a rally in the markets because everyone's going to say that the Federal Reserve Bank's fight on inflation is over and the inflation problem is gone. But the inflation problem is also causing a slowdown in the economy. And banks aren't the only entities that are being affected by interest rates. You have a lot of companies in many different sectors around the economy that are also being affected. So understand that, yeah, we saw SVB get hit very hard. Sure, they could have been protected if they raised a little bit more money, but they weren't able to raise money fast enough to protect themselves for failing. And so understand that, look, this is going to be around for a little while, and you want to make sure you're protecting yourself with the right financial education and staying up to date on what's happening because next week, the Federal Reserve Bank is going to make a huge decision on what's going to happen. And if they decide to pivot, if they don't stay aggressive on interest rates, But then that tells you that they're not willing to do what it takes to bring inflation down, and it's going to take a lot longer to bring inflation down. And if inflation stays high, that is going to be very bad for the long-term health of our economy and our dollar. So you want to stay tuned to what the Federal Reserve Bank is going to say, and we'll keep you posted on market briefs, and I'll try to do what I can to keep you posted here as well.